I was looking at my phone this weekend, just trying to relax for a second, maybe grill a little bit. And I had this profound realization. A single red line on a chart has the power to just completely ruin a perfectly good Saturday. It's ridiculous, isn't it? But we've all been there.
It is the hazard of the trade, isn't it? You stop seeing the sunset and you start seeing market close candles. It literally rewires your brain.
It really does. You start wondering if the steak you're grilling is, finding support or if it's about to break down.
Is this burger forming a local top?
Exactly. It messes with you. But we're going to try to untangle some of that wiring today. Welcome to Inside Bitcoin.
It's good to be here.
So we have to talk about the vibe right now. Because if you're a casual observer, maybe you just check your 401k once in a while. You probably think the economy is, booming. You look at the S&P 500, you look at the NASDAQ, and it is a party. I mean, equities are just punching through all-time highs. Tech is flying. It looks like up only.
On the surface, absolutely. It looks like a euphoric bull market. There is a lot of champagne popping on Wall Street at the moment.
But then you open up the crypto charts, and all of a sudden the music just stops. Bitcoin feels heavy, sluggish. It's barely holding on while NVIDIA is doing victory laps, and that divergence is freaking people out. So the mission for this deep dive is to figure out why. Why are we seeing these mixed signals? Is Bitcoin broken, or is it seeing something the stock market is missing?
That is the billion-dollar question, isn't it? Is it a lag, or is it a warning?
Exactly. We're going to strip away the headlines, look at the actual price structure, the liquidity mechanics, and just so we're all on the same page, the insights for today. This research comes from Mo and the Mostradamus research team.
Which is great because they take a very data-centric, almost mechanical view of these things. They strip out the emotion, which is exactly what you need when things feel this confusing.
Yeah. Okay, so let's just get right to it. The elephant in the room. The common narrative on, Twitter or X is that Bitcoin acts like a tech stock on steroids. That's what we've been told for years. So the logic follows. If tech stocks go up, Bitcoin should go up even more, but it's not. Why?
Well, it comes down to a really fundamental misunderstanding of Bitcoin's role in the whole global liquidity cycle. Most people, even, seasoned investors, they think Bitcoin is a lagging indicator, meaning it waits for the S&P 500 to make a move and then it kind of plays catch up. The research we're looking at today argues the exact opposite. It suggests Bitcoin is the leading indicator.
Okay, let's unpack that. So you're saying Bitcoin isn't late to the party? It's actually the first one to leave.
Precisely. Think about what Bitcoin really is. It is the purest asset for global liquidity. It has no earnings reports to mask performance, no CEO spinning a narrative, no government bailouts. It's purely a reflection of money supply and risk appetite. And because of that, it's incredibly sensitive. It's raw data. It sniffs out changes in the wind, changes in liquidity conditions, weeks or even months before the stock market does. Equities have a lot of inertia, they have buybacks, institutional momentum. They take a long time to turn. Bitcoin can turn on a dime.
So when we see Bitcoin struggling while stocks are still pushing new highs, we shouldn't assume it's just gathering energy to catch up. That's the mistake.
That is the dangerous assumption, yeah. The interpretation here is much more bearish for the broader market. The thesis is that Bitcoin has already signaled the shift. It has felt the liquidity drying up. The belief is that next, we're going to see the major indices, the S&P, the NASDAQ, roll over and follow the path Bitcoin is already carving out.
That is a pretty contrarian take. I mean, Wall Street is incredibly bullish right now. If you tell a standard stockbroker that a crash is coming because Bitcoin said so, they'd probably laugh you out of the room.
They usually do.
Yeah.
Until it happens. It's a classic case of the tide going out. Bitcoin is the small boat that hits the bottom first because it sits shallow in the water. The massive cruise ships, the Apples and Microsofts, they take longer to turn, but they're floating on the same water. If the water level drops, they eventually run aground.
So for the listener trying to figure out their next move, this distinction is absolutely critical. If you think Bitcoin is lagging, you might buy now thinking it's cheap relative to stocks. You think you're getting a discount.
Right, and that's how you get trapped. You buy the lag thinking it has to catch up, but instead the asset you were benchmarking against just comes down to meet you.
But if Bitcoin is leading, then buying now is like trying to catch a falling knife.
Exactly. And this view, it's based on a position trade mindset. This isn't about scalping a 2% gain on a Tuesday. It's about macro positioning. If Bitcoin is the leader to the downside, the strategy is patience. You don't fight the current just because the stock market hasn't realized the current has changed yet.
It really sounds like we're just waiting for gravity to kick in for the rest of the market.
Essentially, yes, gravity always wins.
Okay, so if we accept that Bitcoin is the canary in the coal mine, we need to look at what's killing the canary. And looking through the notes, there's a huge focus on the DXY, the US dollar index. Now, I got to play devil's advocate. I thought we were analyzing Bitcoin. Why are we spending so much time looking at Forex charts?
It's a fair question. People want to see the Bitcoin chart, not some boring dollar chart. But here's the thing. You cannot analyze Bitcoin in a vacuum. You have to look at the denominator.
The denominator, as in the currency we price it in.
Right. When you look at the price of Bitcoin, you're not just looking at Bitcoin. You're looking at a ratio, BTC divided by USD. If the value of the USD, the denominator, changes drastically, the price of Bitcoin has to move, just mathematically.
So it's like measuring your height with a tape measure that keeps shrinking and expanding. If the tape measure shrinks, you suddenly look taller. If it expands, you look shorter.
That is the perfect analogy. And right now, that tape measure, the dollar, it's looking like it wants to expand. The analysis focuses on the DXY because it's the ruler for the entire global market. And historically, they have a very strong inverse correlation. A bullish dollar generally means a bearish Bitcoin.
Okay, simple math. A stronger dollar means weaker assets priced in dollars. But I want to get into the weeds on the weekly candles mentioned in the source material, because there was a point here that I think trips up a lot of new traders.
You're talking about the open of the candle.
Yes. The material says the DXY weekly candle opened to the downside. So my logic says, red candle, price going down, dollar is weak. That should be good for Bitcoin. But the analysis says this downside open is actually bullish. Can you walk us through that?
It's very counterintuitive, I get it, but we have to think about how a candle is formed over a whole week. Rarely does a market open on Monday and just go straight up until Friday. That almost never happens.
Right, there's always some chop.
There's usually a wick, and you can think of a wick as a fake out. The market pushes price one way first to trap traders, to gather liquidity, and then it reverses for the real move.
It's like pulling back a slingshot. You have to go in the opposite direction first to generate the force to go forward.
That's it. That is the perfect visualization. So when the DXY opens the week and immediately pushes down, the research views that as constructive for a rally. It's the slingshot pulling back. It's trapping people into shorting the dollar, and then boom, it rips upward later in the week and squeezes them all out.
And looking at Bitcoin, did we see the mirror image of that play out?
We did. And this is what confirms the relationship. While the dollar was doing its downward fake out, Bitcoin opened the week with a bullish fake out. It popped up early.
Which feels great in the moment, right? You see green, you think the correction is over. You text your friends, we're back.
It feels amazing. But structurally, it is the same trap in reverse. Bitcoin lured in the early longs, the people with FOMO, only to, well, likely reverse on them as the dollar finds its footing. So you have the dollar setting up for a rise and Bitcoin setting up for a fall. The two signals confirm each other perfectly.
That's really fascinating. It's almost like a dance. One leads, one follows, but they're stepping in perfect opposition to each other.
It just shows the market isn't random. It's highly mechanical if you know what you're looking for. It's all about liquidity traps.
Okay, so we have the DXY signaling strength, which implies Bitcoin weakness. Now I want to zoom out, way out. We've been talking weekly candles. Let's look at the monthly view. This is where we get into what Mo's research calls the macro ceiling.
Right. And this is where the gravity of the situation really starts to set in. When you look at the monthly time frames, you strip away all that daily noise, and what you see is that Bitcoin has been trading inside a massive 8-year channel.
8 years. That's basically Bitcoin's entire relevant history for most people.
Pretty much. This channel has defined the highs and the lows for almost a decade. And recently, price did something very, very critical. It hit the upper resistance trend line of that channel.
The ceiling.
Yeah, absolute ceiling. And it was rejected. It didn't smash through. It didn't hold. It hit it and bounced off.
Yeah.
The implication here is, well, it's significant. The belief is that this rejection marked the top of this cycle.
Whoa, hold on. That's a heavy statement. We're saying the top is likely in.
Based on this long-term channel structure, yes. The rejection from that 8-year resistance is a major, major technical signal.
But here's where it gets really interesting. The forecast isn't just straight down from here. There's a twist that I think might confuse people if they aren't listening carefully. The analysis talks about a relief rally.
Right, and this is the danger zone for FOMO. This is where you can lose your shirt if you aren't paying attention.
Because the numbers being thrown around for this relief rally are They're huge. We're talking a potential move toward the 100K to 105K area.
It sounds totally contradictory, doesn't it? The top is in, but hey, we're going to 100K.
Exactly. If I see 100K on my screen, I'm thinking, new bull market, let's go.
Yeah.
Why is the analysis saying that's actually bearish?
Because context is everything. In complex market structure, markets don't just move in straight lines. Even in a downtrend, you get these massive upward corrections. The analysis views a move to 100K, even 105K, not as the start of a new leg up to 200K, but as a corrective move. It's a retest of that resistance before the next major leg down.
So trap.
In a way, yes, it's a rally designed to convince everyone the bull market is back on right before that larger resistance structure just swats it back down. It's a rally within a broader structure of resistance. So what for the listener is this. If we see 100K, do not blindly assume we are off to the races. You have to recognize where we are in that 8-year channel. We are at the ceiling, not the floor.
That is such a critical distinction. It completely changes how you react to seeing a big green number. You're not celebrating, you're being cautious.
Exactly. It shifts your mindset from how much can I make to how do I protect my capital? You see 100K as a potential exit, not an entry.
Now, I want to pivot a bit. We've been very chart-heavy, very technical.
Yeah.
But we live in the real world. You turn on the TV, it's geopolitical tension, elections, conflict. It feels like the world is on fire half the time. How does that real-world stuff impact these charts? Does a war breaking out just shatter this whole 8-year channel analysis?
This is one of the most common questions. What about the news? And the perspective here is what we could call the narrative alignment theory.
Narrative alignment. Okay, I like that. What does it mean?
It means that the analysis doesn't really factor in geopolitical events as primary drivers. We aren't trying to predict what some country will do next week. The theory is that the charts, the price action, the liquidity flows are already signaling the direction.
So the chart knows before the news anchor does.
In a sense, yeah. The capital flows move first. Smart money repositions first. So if geopolitical stress escalates, if things get scary, it usually doesn't contradict the chart. Instead, it aligns with the narrative the charts were already setting.
So you get an example of what that feels like?
Sure. Let's say our analysis says, okay, Bitcoin looks heavy, DXY is strong, we expect a drop, and then boom, a geopolitical crisis hits, the market dumps. The news will say, Bitcoin crashed because of the crisis. But the technician says the crash was statistically probable anyway. The crisis was just the catalyst that triggered the move we were already positioned for.
So the news is just the gas pedal, but the chart is the steering wheel.
That is a brilliant way to put it, yes. The charts are already signaling DXY strength, BTC weakness. If a major event happens, it'll just be the excuse for the market to do what it kind of wanted to do anyway.
That's actually kind of comforting. It means I don't have to be a geopolitical expert to trade this stuff. I just need to trust the data.
It removes the emotion. You stop reacting to every breaking news banner, and you start looking at the structure. It keeps you sane.
So bringing this all back home, we've covered the dollar, the 8-year channel, the lagging versus leading debate. If you had to boil this all down to one final strategic thought for the listener driving into work right now, what is it?
The key question is still, will Bitcoin continue to lead lower or will it lag? And the current view is, well, it's pretty definitive. Bitcoin is leading. It is showing us the path.
And the advice that comes with that.
Remain patient. That is the hardest thing to do in a market that moves this fast. Allow price action to confirm the thesis. Don't just react to the noise. If the thesis is that 100K is a corrective rally, wait. Wait to see how price reacts when it gets there. Don't FOMO in. Let the chart prove it to you.
Patience is profitable, but man, it is boring.
Boring is good. Excitement in trading usually costs you money. If your heart is racing, you're probably risking too much or you just don't have a plan.
Ain't that the truth?
And if we connect this to the bigger picture, just remember that knowledge is really about seeing the pattern before the crowd does. The crowd reacts to headlines. The crowd chases green candles. You want to be positioned for the structure. You want to be the one selling when the crowd is finally confident enough to buy.
Well said. So the takeaway for today, don't let the all-time highs in the stock market fool you. Watch the dollar. Watch that 8-year channel resistance. And remember, just because Bitcoin isn't partying with the tech stocks doesn't mean it's broken. It might just be the only one in the room telling the truth about what comes next.
Precisely. Keep your eyes on the liquidity.
If you want to continue the conversation and stay updated on Bitcoin price action and developments across the Bitcoin DMT ecosystem, check out the Discord link in the description or on the channel, where Mo will be sharing ongoing research, insights, and updates. We'll see you next time on Inside Bitcoin.